what we would call our general ledger. I mentioned to you that sometimes, so when we record things in our journal, we show the debit and the credit, the two accounts, and it's chronological. Each time a transaction occurs, we record it. But then we have to transfer over our journal entries to what's called a ledger. And a ledger is what allows us to keep a balance for each account. There's kind of two different styles of doing ledgers. The first one I already showed you an example of, and that's the T account. So the T account is like a really simple ledger that has the name of the account up here. So we'll look at like cash. And then each time I debit the account, I do the amount. So that first transaction was a debit of 25,000. The second transaction was a credit of 20,000. And so forth. Each time I have a transaction, I just record it on that T account. A more fancy way, I don't know what you want to call it, is a ledger that shows not just the T account. If you think about it, these would be the parts that go on the T account, but it keeps a running balance too. When you do a T account, what you do is at the end of the month or whenever you're done, you just total it out and say, okay, what's the balance? Is it a debit balance or a credit balance? Here, what we do is we keep a running balance. So it has the date. It has, don't worry about post references that much. Okay, but it has whether there was a debit or a credit, and then it has the balance. So you can see when they debited 25,000, the new balance became 25,000. Then they credited 20,000. So the new balance of the account is a debit of 5,000. Does that make sense? So the balance of the account is just the difference between the debits and the credits at any given time. And then it goes, so you'll never have a negative number in any of this. You'll either have a debit balance or a credit balance. So if we were going to have negative cash somehow, which we wouldn't, but if we did, you just have a credit balance to the cash account. Okay. So you can see this is our cash account and all of those transactions. And in the end, we end up with a balance. In this case, a debit balance of $2,065. Our accounts receivable, again, the first transaction was a debit of $1,750. Then someone must have paid us $650. Then, and then another $1,120. And so the balance just updates each time. This is one of those things that once you do it a few times, you're like, this is incredibly easy, right? Each time I do an entry, I put it over to the journal so that I can know the balance. In the old days, and the reason these are called books, okay, in the olden days before me, what you had in essence was you had this book that was split into sections, and the first section was the journal. And so you'd record your transactions each time they happened in the journal. And then there were like these tab sections at the back, each with a ledger page. So if I recorded this transaction of cash and common stock, I'd record the journal, then I'd turn the tab to the cash page and record this date, cash increased by 25,000 was debited, here's the balance of cash. Then I'd flip to the common stock page and I would record this date, and I'd credit it. And so it was all there in the books, right? And so now, as you can imagine, computers make that so much easier. In essence, all I have to do is hit the one entry and it posts it straight to the ledger for me. Thanks, QuickBooks, or whatever software you're using. These are all just the other general ledger accounts. I don't want to explain them. They're just all there for us. All right.